Kadena, once hailed as one of crypto's most promising blockchain ventures, has announced it is shutting down operations after running out of funds. The financial collapse of the company founded by former J.P. Morgan executives has rendered their Kadena blockchain a ghost chain, technically operational but economically abandoned. While the blockchain network will remain online due to its decentralized nature, the organization said it will cease all business activity and active maintenance. The announcement sent KDA plummeting over 47% in 24 hours to 12 cents, down 77% in a month, and more than 99% from its all-time high of $27.64 set in 2021. Kadena's mainnet went live in January 2020, promising to combine Bitcoin-style security with high throughput through an architecture known as braided chains. Founded by former J.P. Morgan engineers Stuart Popejoy and William Martino, who had previously helped the bank explore blockchain initiatives, Kadena set out to build a scalable proof-of-work blockchain designed for business use. At its peak in 2021, Kadena's token reached a market capitalization of nearly $4 billion, supported by a growing community and a $100 million grant program for Web3 developers launched in 2022. The project's technological innovation, ChainWeb, a system of 20 braided proof-of-work chains running in parallel, theoretically allow for up to 480,000 transactions per second, dwarfing Bitcoin's 7 TPS and Ethereum's 15 to 25 TPS. But the network struggled to attract sustained adoption. Kadena's announcement added that the decision came after market conditions made it impossible to sustain operations or promote the project's adoption. The team said it would retain a small group of employees to oversee the transition process and assist with winding down operations. The prolonged bear market decimated the project's treasury, much of which was likely held in its own token. With KDA down over 99% from its peak, maintaining a full-time team and funding ecosystem efforts became unsustainable. According to data from DeFi Llama, Kadena's total value locked in DeFi has plunged to just $128,000, down 71% in 24 hours, and a far cry from its all-time high of $11 million in August 2022. This represents one of the most dramatic DeFi collapses in recent memory, highlighting how quickly liquidity can evaporate when confidence erodes. Most of its DeFi protocols have suffered sharp declines in liquidity. Kadena Cabinet, a governance platform, dropped over 70% in TVL in the last day, while decentralized exchanges like KD Swap and Mercatus fell by 83% and 64%, respectively. The ecosystem that once held promise as a business-grade DeFi platform has been reduced to a skeleton of its former self. In the aftermath, exchanges have started delisting the token. CX announced plans to delist KDA trading pairs, KDA/USDT and KDA/USD, by October 29th, citing failure to meet listing requirements. Deposits have already been suspended as of October 22nd, with withdrawals set to close on January 22nd, 2026. Additionally, another CX announced the end of perpetual contracts on KDA, effective October 2nd, and has ceased all lending and borrowing services related to KDA. These delistings represent a death knell for liquidity, as centralized exchanges were often the primary venues for KDA trading. With major platforms abandoning the token, remaining holders face increasingly limited options for exiting positions. The delisting announcements triggered panic selling, creating a cascading effect that pushed prices even lower. Many investors who had hoped to exit found themselves trapped, unable to sell meaningful amounts without moving the market dramatically against themselves. This liquidity crisis transformed what was already a severe downer into a near-total collapse. Despite the company closure, Kadena said that while it is stepping away, the blockchain will continue to function independently as a proof-of-work network maintained by miners and governed by on-chain smart contract developers. The company said it would soon release a new binary to ensure uninterrupted operation and encouraged all node operators to upgrade. The project's token and protocol will also continue to function as 566 million KDA remain to be distributed as mining rewards through 2139. Also, around 83.7 million KDA are still set to come out of lockup by November 2029. The team said it will engage with the community on transitioning to full community governance and maintenance. This creates an unusual situation where the blockchain exists but lacks active development, marketing, or ecosystem support. In the statement, Kadena emphasized, the Kadena blockchain is not owned or operated by the company. It is operated by independent miners, while on-chain smart contracts and protocols are governed independently by their maintainers. However, without an organization driving partnerships, adoption, or upgrades, the network faces an uncertain future. Mining may continue as long as it remains profitable, but declining transaction fees and user activity could eventually make it economically unviable. Kadena shuts down news left investors reeling. On X, one longtime holder, Lu Fu, wrote that it lost more than 90% of his investment and accused the project of being a scam, noting that the team had continued making corrections and updates shortly before announcing the shutdown. My journey with KDA also ends here, he said. All my investments have lost value, and so has my faith in crypto. Some industry figures have responded with sympathy and possible interest. Cardano founder Charles Hoskinson publicly offered to connect with the Kadena community following the announcement, hinting at potential collaboration or support. While the practical implications remain unclear, Hoskinson's outreach suggests that remnants of Kadena's technology or community might find new life within other ecosystems. The shutdown has also reignited debate about the long-term sustainability of Layer 1 blockchains. Analysts pointed out that despite Kadena's technical innovations, the project struggled to attract users in a crowded market dominated by Ethereum, Solana, and their growing ecosystem of rollups and Layer 2 networks. Kadena's collapse has become a cautionary example of how projects built on technological ambition fail to secure meaningful adoption. Founded on the promise of scalable proof-of-work innovation, Kadena was once positioned as the blockchain for business. Yet, as user activity and liquidity shifted toward ecosystems with deeper network effects, Kadena's vision faltered. The lesson is clear. In crypto, technology alone doesn't guarantee success. Network effects, developer ecosystems, and user adoption matter more than raw performance metrics. Kadena could process 480,000 TPS in theory, but with minimal actual usage, that capability was meaningless.